We had excellent revenue, $5.4 billion, up 2%. We had extraordinary strength in our pre-owned business, which we have one-priced. We are in that magic period where we have higher volume, plus 5%, and we were able to improve gross margin per unit sold. And when you put that multiplier effect together, the gross profit in our pre-owned business improved by 22%. So really strong pre-owned business. And in our financial services business, we continue to lead the industry with our results per unit sold. And we had another 10% improvement on already record levels to a new record level per unit retailed. Excellent performance in our customer care, particularly customer pay was up 7%, but up 4% overall in customer care. The headwinds, though, were in our margin per vehicle retailed on new vehicles. That remains very competitive, and we had about a 7% decline on a same-store basis in gross profit in our new vehicle business. But you put it all together, it's a 24% improvement in EPS year over year.
Wow. Let's talk about some of the specifics you just laid out. New vehicles. You've been talking about this for a long time. It's why you changed kind of the format for AutoNation and have been relying more on service and different things. Why do you think it is that new vehicle sales have been so challenging? Is the consumer tapped? Is this a situation where car prices have just gotten so high that they can't go any higher? What's really happening?
The consumer is still very much in the marketplace for new vehicles. I don't think that's really the issue. And of course, you have this massive shift towards trucks, which is now approaching 70% of the business. So this year will be high 16 million, if not touching 17 million on a unit volume. And credit remains very available and very affordable. I think in the volume marketplace, though, margins are tough. You have greater transparency from a digital point of view that really empowers the consumers. And you have incentive programs from the manufacturers that really hyper competitize the marketplace, that it's pretty cutthroat on margins. You put those two together, and there's new vehicle margin pressure per unit sold.
Mike, you've also talked to us a lot about higher oil prices, higher prices at the gas pump, and what that means. Obviously, the companies that are manufacturing these cars and trucks are making a lot of money on the trucks and SUVs. That's been a profit center for them. As prices go up, have you seen any reluctance on the consumer's part to pay for those, or is that still what is the primary demand?
Yeah. I think the American consumer is firmly in the high seating position of a truck. They like the view it gives them, the empowerment. And by trucks, I'm counting SUVs, minivans, and pickup trucks. You put them all together, it's about almost 70% of the marketplace. And I don't think the American consumer is going to give that up easily. They also like the utility that comes with that, and they like the style that comes with it. And by the way, the manufacturers have done a fantastic job of improving the fuel economy of everything from pickup trucks to SUVs. So it's not the issue it once was. So I think the price of gasoline would have to be well over $4 a gallon, if not $5 a gallon, to change the consumer's preference as to going with a high seating position SUV pickup truck versus going back down into a car. So I think this is a structural change for the industry, which is very beneficial for the manufacturers and the suppliers. Their margins are excellent in that segment. Not the least of which is, you know, they have a 25% import tariff protecting pickup trucks, which the administration never likes to talk about when we get the tariffs in trade. So it's a cash cow for the manufacturers.